if you are doing value investing and you want stability, right, of course you want to find companies that show consistent profit growth. So for Magni-tech, right, when the time I invested, right, it was growing at double digit, profit is growing at double digit, PE is single digit. The best that an investor asks for is a company that is cheap but also got growth story. So that's what happened to Magni. That's why I took these case studies. So at that time, they have some growth story. Their prospect is strong. Their sales is strong. Order book is strong. So yeah, all is good. They are cheap, okay, because they got a single customer risk. That's why the market did not like it. But of course, you cannot build your portfolio all in Magni. Then you got a whole portfolio risk. So if Nike run away from Magni, then your whole portfolio also cut, gone case. An investor must first know about yourself. You must know exactly what are your risk appetite and what works for you, because not all investing strategy fits everyone. So different person has a different strategy works for them. For me, I find that I am not so into trading because I actually got not much time to monitor the stock market. So I have more time for trading. So when it comes to, I have more time for investing. So when it comes to investing, right, it doesn't require so much time. So you need to find one that works for you. If you look for stability, of course, the idea, for me, right, I split my portfolio to two. One is for growth, one is for stability. For stability, of course, I go value investing. I buy stock that are trading at a undervalued, undemanding valuation price, but still show growth potential. There are and there are companies like this in the market, but just that you have to find, you have to dig a bit more, do a bit more. You have to do a bit more. I would say that you need to do more like a bottom-up approach. You need to do a bottom-up approach to find out what are the companies that are trading at undemanding valuations because of maybe some negative news, one-time negative news. So the share price dropped to that level. Then you need to find them. Of course, when you find them, right, we need to find that they have a consistent profit growth. For me, little debt, don't have too much debt, and then have strong cash flow, and then the price is attractive. Because great companies may not be great investment, but great companies at fair price is a good investment. So not only we want to invest in great company, but we want to buy them at fair price, because it is only a great investing when it's sold at a fair price to you or attractive prices to you. So you must wait for that moment. So if you find this company, consistent profit growth, little debt, strong cash flow, then you must put them in the watch list. So when you put them in the watch list, whenever there's a one-time bad negative news, okay, hit the company, the share price drop, right? Then we took the opportunities, to buy into this company. Okay, the opposite of bottom up is a top down. Top down means you look at the economy, you look at the world economy where the money flows, then you go look into the sector, you find the sectors that will boom in this economy, then you find the industry, you find the best company in that industry, and then you invest in the company. But sometimes, right, if you follow this kind of top-down approach, you may not be able to find a cheap undervalued company, because if you find a hot industry, right, chances are the share price already at a higher valuation already. So I think right, top-down approach is more suitable for growth stocks. Okay, but when it comes to undervalues, right, you need to do more bottom up. That means terbalik. You don't have to look at the economy. You need to find where people find the diamond in the what do you call it, diamond in the rough. Okay, you need to go to a place where it is contrarian. Okay, people really did not like the idea. People dump it, and then you go there and see whether this company still got growth prospect or not. And then over the past few years, is it still growing well? Then when you find it, then you wait for the price to go down. Then you buy that. Of course, it's often easier said than done. So you have to really do your own homework to discover these kind of stocks.